Now, very often when we hear economists, analysts, commentators talking about, say, factors that drive the overall economy, we have a distinction made between what are known as macro level factors and micro level factors. And what I want to explore in this video are certain what we might call macro level KRIs or key risk indicators. This is information that's actually available from the markets themselves, having to do with various kinds of pricing of various kinds of instruments, for example, whether it be credit default swaps, interest rate swaps, or whether it be spreads in the money markets. And the better that we can understand this information coming from the market, maybe the better we are at navigating our way, for example, through the capital markets. All organizations should develop their own set of KRIs that operate at the local or micro level. And these risk indicators will be primarily subject to idiosyncratic factors, factors specific to the actual business itself. These KRIs will focus on providing alerts for potential business disruptions. Examples could include deviations from well-established historical trends. However, the 2008 crisis revealed financial contagion or systemic risk factors, and these created much enhanced correlations in the performance of all financial organizations. So we're going to focus on these macro level KRIs, and these include system-wide stress indicators from activity in the capital markets and also the general health of the banking system. So I've mentioned the crisis of 08, which could well be characterized as a systemic liquidity crisis. I even wrote a book where that is featured in the title of the book. So let me just discuss the graphics on the screen here. Over on the left, this is a systemic liquidity risk index that was developed after the fact by the International Monetary Fund. They put this paper together sometime, I think, in 2012, and they said, wouldn't it have been useful to have had a systemic liquidity risk index as we moved into the crisis period? There was not such an index, but they have now, if you like, created one and retrofitted the data to see how it would have performed in the lead up to the crisis. So let's have a quick look at these timeline indicators. This is number one, which was effectively when Bear Stearns was acquired by JP Morgan at a rock bottom price and otherwise would have failed, and that would have preceded the Lehman Brothers crisis here, or the collapse of Lehman, in September 08, number two. And number three is the beginning of what we now call the Eurozone crisis or Greek debt crisis. And since, as I mentioned, the white paper that the IMF developed was put together in 2012, this obviously only covers the beginning period, does not actually include the default eventually of the Greek sovereign. So what they did was they created these indicators, which I'll come on and show you in a moment, and then they established a kind of a mean level, a zero level if you like, and then the scale over here represents the number of standard deviations either above the mean or below the mean. So we are looking here, for example, after the collapse of Lehman in September 08, we came all the way down essentially to -6 standard deviations away from the mean, or what would have been essentially a healthy position with regard to systemic liquidity. As you can see, we recovered quite quickly, went back up, but then the beginnings of the Eurozone crisis brought us down again into -2 standard deviations. And if this study had been conducted sometime in, say, 2012-13, we would have come quite a lot way down. We would not have come down to the same level as occurred in '08, but we would have come down probably to about -3 or even 4 standard deviations. Now, over on the right side, this is a liquidity index that the Bank of England had, which was not retroactively created, and it shows a rather similar situation to what the IMF eventually did create. So let's just have a quick look at some of the indicators within this IMF SLRI. There are various money market spreads and rates, for example. This, for example, would be the LIBOR OIS spread. Now, LIBOR has obviously disappeared and been replaced by, say, US dollar SOFR, but at this point in 07-08, LIBOR OIS, the LIBOR OIS spread was a key indicator of basically risk in the banking sector. LIBOR was an unsecured rate and the overnight index rate was a fully secured rate. So to the extent that this spread widened, which it did, of course, as we went further into the '08 period, this reflects uneasiness in the banking sector because banks became very cautious and basically didn't want to lend or borrow on an unsecured basis. And we can see just one more that I'll mention here, margins and haircuts in the repo market. In a normal, inverted commas, environment, there might be very low margins or haircuts applied, say, especially for very secure collateral, such as US government bonds, for example, or other kinds of bonds. But as the tensions in the money markets develop, then obviously the haircuts that would be applied become very substantial. I might mention that, say, in the lead up to the '08 crisis, it was at one point possible to use, say, a mortgage-backed security as collateral in the New York money market, with a fairly minor haircut being applied to it. But as we move further into '08, these haircuts moved dramatically up into the region beyond 50%, when effectively that market for repoing MBS became dysfunctional. Now, another really key KRI at the systemic level really is this one illustrated here, which is the VIX. That stands for the CBOE. This is the Chicago Board Options Exchange Volatility Index. Now, let me just explain what the VIX is. It is a real-time data analysis being conducted by the Chicago Board Options Exchange with regard to trading of S&P 500 index options. And the way it would work is that people obviously are buying and selling these options on a substantial basis. There's high volume in this particular product. And what the CBOE can do in real time is to back out, reverse engineer essentially what the implied volatility is being expressed at any point in time based on the pricing of call and put options on that index. And then what we can see, this by the way is essentially a percentile scale over here on the right, is that when this VIX surges, as it has done throughout this very long period on the screen, this actually correlates very closely to periods of high volatility, anxiety, fear. Sometimes this is actually called the fear index. So this goes all the way back to 1990. This index can be monitored in real time. And in fact, you can actually speculate on the VIX. There are, for example, futures contracts on the VIX. So if we look across the timeline here, we can see some incidents here. This was back in 97, an FX crisis in the Asian markets. This is the collapse of a very large hedge fund, essentially. 9/11. This was the bursting of the dot-com bubble, which caused a big collapse in the NASDAQ. This, of course, is the largest single incident which was the beginnings of the '08 crisis following the collapse of Lehman Brothers in September '08. We have an incident here known as the flash crash. This is the Eurozone crisis. I was just referring to that a moment ago. We have another surge in the VIX here. This coincided with when the People's Bank of China decided to realign the renminbi, not particularly against the dollar anymore, but against a basket of currencies. That caused great concern in the markets. Now, we almost got to the same level that we did with the collapse of Lehman in the first quarter of 2020, which coincides, of course, with the onset of the COVID pandemic. We had another surge here in August of 2024, and that actually in many ways coincided with a massive unwinding of the dollar-yen carry trade. And the most recent on this timeline, as can be seen here, goes back to April of 25, which is now known as Liberation Day, which was when the Trump administration announced the first go round on the tariffs issue. Let me now explain this slide, and I like this slide very much. This relates to the way in which, say, the expansion of credit, primarily by the banking system, of course, drives what might be called an asset price cycle. Now, this is not a defined periodic cycle. This is something that has occurred throughout history, and we could even see it well exemplified in the lead up to the '08 crisis. So the idea is, and you can see the source of this down here, is let's say we are thinking in terms of, say, 2003, 4, 5, and so on. We have increasing asset prices. This would apply to equity markets, real estate markets, values of business, etc. And during this period, say starting in '03, we have a sustained increase in asset prices. Now, if we move around the outer loop here, we can consider this as the supply of credit into the financial system by the banks primarily. So this period with increasing asset prices would be very favorable for the banking industry. Very few credit losses. People aren't unable to pay their loans. Few people going bankrupt and so on. This leads to relatively high bank profits. The banking industry has its confidence reinforced, and of course the high profitability also increases the capital base of the banking industry. As a result of all this, banks are favorably disposed towards granting credit, and in fact they do. They are willing to lend. The inner loop represents, if you like, the demand for credit. And based on this expectation of increasing asset prices, which has now become, say, a well-established trend over the last 3, 4, 5 years, what have you, there is increased demand for credit. People want to borrow to buy more equities, to buy more property, to expand their businesses. The banks are willing to lend, and this obviously thereby becomes a self-fulfilling, a positive feedback loop, which of course then keeps increasing asset prices even further. Now, eventually, of course, what happens is that these asset prices become unsustainable. A bubble has arisen, and the bubble eventually bursts. That then leads, if you like, to the more or less complete opposite of the last slide, which we can call the downswing, if you like. And now we have asset markets plunging, crashing. They don't go down gently, they crash. This is a very bad environment for banks. People are unable to pay back their loans. People are going bankrupt. The banks start losing money. This leads to a decrease in their capital. Banks become very wary about extending credit. They don't really want to extend any credit at all. And if you look into the demand loop, if the markets are now crashing, there's very little demand for credit. Many people have borrowed already too much. Many people are declaring bankruptcy. People are unable to continue to service their debt and so on. So the demand for credit drops off a cliff. And of course, this then becomes a nasty, vicious downward feedback loop. Let's just have a quick look at the slide on the screen now, also relating back to the '08 crisis. And we can see here the 6 very large US banks. And we can see here the leverage of these 6 banks on a quarterly basis, again captured by the old FSA. And the way the leverage is defined here is the total assets of these banks divided by how much equity they had. A kind of form of CET1, not strictly speaking as defined under Basel III. But let's say we take, for example, here Morgan Stanley. This is as we're going through '07, beginning to go into the '08 period. And Morgan Stanley's leverage was effectively up close to 35-1, which means in a sense that their equity was only 3% of the value of the assets on their balance sheet. It wouldn't take much of a correction in the valuation of those assets to essentially lead to the bankruptcy of Morgan Stanley. We can see a very similar position here for Lehman Brothers, and as can be seen, the red line runs out because this is in fact where Lehman did collapse. Goldman was not quite as leveraged as those two, but fairly similar. But as we can see, as we came out of the crisis going into the '09 period, all of these 6 banks now had reduced their leverage substantially down to around 10-1, or essentially a 10% amount of capital against the assets on the balance sheet. I mentioned the health of the banking system a while ago, so let's have a look at some indicators, systemic indicators relevant to this issue. So we're going to compare book value and market value. So let me just say a little bit about this. From an accounting perspective, the value of a bank's equity capital shows the current value of the bank's assets minus its liabilities, what you might call the net worth of the banks. Now, in the case of many companies, let's say we take, I don't know, Apple, Nvidia, Google, what have you, the value of assets is far harder to determine than it would be in the case of a bank. You have all kinds of issues with, say, companies which have plenty of intellectual property. What are the value of algorithms, patents, and copyrights, and so on? A bank's balance sheet is much simpler, relatively speaking. You could argue even that that's what banks do for a living, is they constantly value their assets against their liability. The market value of a bank essentially is its market capitalization. And this is the product of all outstanding shares issued by the bank multiplied by the current share price in the marketplace. This ratio of price to book, as it's called, reflects the market's view as to the quality of the bank's balance sheet. Now, what I did here was, over here on the right, I took some price to book ratios as of July 2025 for these big American banks and also European banks over here on the right. I apologize for the fact that my face is actually obscuring some of these here. I know roughly what these actually were, but as of July 25, we can see JP Morgan has a price to book of 2.48. Now this historically is very high, very high. Bank of America, more typical level, 1.3. Morgan Stanley, again, very high, somewhat similar to JPM. Wells Fargo, Goldman just above 2. And Citigroup down here is actually the outlier with the lowest, effectively a 15% discount, which the market cap has against what the net worth determined by, say, an accountant would be. So it's a 15% discount. This does not reflect a great deal of confidence by the market in the balance sheet, essentially, of Citigroup. We can see here with regard to the European banks. Now, these are much lower, as can be seen. These are more typical from a historical point of view of this kind of ratio, price to book ratios. We can see here, say, for example, UK bank Barclays, 0.63, Deutsche 0.6, Banco Santander just a little above 1. HSBC happens to have the best price to book here at 1.4. BNP Paribas. I think SocGen actually is the weakest of all of them. NatWest is around 0.8, if I recall correctly, and UBS is just a little above 1. Now, this is a fairly recent perspective on the price to book, but over here, if you want to have a look at this publication by the Bank for International Settlement, they have shown that the price to book ratios from a historical point of view have, as I said before, been somewhere closer to 1 than 2.5, and it also shows typically that European banks have weaker PB, price to book ratios, than say the United States. One other indicator that I'd like to point to is the spread between the yield on sub-investment grade bonds, junk bonds as they're sometimes called, and US Treasuries. This is quite a key indicator, closely monitored, for example, by analysts, by people in central banks, and so on. As you can see, I captured this from the Federal Reserve's own database, FRED, and it goes back to 1997 or thereabouts. And the idea is that when this spread surges, as it did here, for example, with regard to the '08 crisis, what we are seeing essentially is the market's antipathy or unwillingness really to want to own high yield or junk bonds. And that means that the yield, the difference between the yield on these versus the US Treasuries, surges to extreme levels. Here, for example, it went up to 20%. You can see some other movements here. For example, this also was when this yield spread surged. This again relates back to the beginning of the COVID pandemic. Where we are currently, as of July 25, is this spread is more or less at the bottom of its range, somewhere around 250 to 300 basis points. This yield spread should be monitored closely because clearly what it represents is the market's perception of the risk, credit risk, and possibly even recession risk in the corporate bond market. And one final slide, which I'll finish with, has to do with the profile of the US Treasury yield curve. And what this graphic shows, again from the Federal Reserve, is the spread between the constant maturity 10-year US Treasury, where we subtract from that the yield on the 2-year. Now, in a normal, inverted commas, upward sloping yield curve environment, we would expect that spread to be positive, and maybe quite substantially positive, perhaps 200, 250 basis points. However, from time to time, this spread actually becomes negative. And studies done by, for example, the Federal Reserve branch in New York have actually tracked this idea of what is known as inversion of the yield curve. The inversion occurs when the yield on a 2-year note exceeds that of the 10-year note. So in other words, the spread at that point becomes negative. It becomes below this zero line here. And these studies done by the Fed have shown that there is a tendency when this spread becomes negative, as it did here, for example, towards the end of the 1980s. This then, if you like, is a harbinger of a recession, which is shown here. These grey shaded areas correspond to US recessions. We can see something similar happening here. Even this perhaps is the most interesting of all. This was the inversion of the yield curve in the throughout '07, and that in many ways obviously could have been argued was a precursor to all the all the problems that unfolded in '08, which of course did lead to a significant Main Street recession. Now, over here on the right, which is obviously the most recent period in the 22, 3, 4 period, we actually experience almost the maximum inversion seen on this timeline here. The spreads became negative 100 basis points. So in other words, the yield at this time on the 2-year note was 1 full percentage point above that on the 10-year Treasury note. Now, whether or not that is an indicator that we will be eventually moving into recession, of course, is unknown at this point. And the indicator that I mentioned has not been 100% reliable, according to the Fed study. But I think, if I'm not mistaken, the reliability is around 75+%. So I hope very much that you enjoyed that explanation of these macro level KRIs, and I am adding material along similar lines to my YouTube channel on a frequent basis. So may I suggest that you subscribe to the channel so you can keep up with all these various topics, and I thank you very much for watching.